Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you or someone close to you is concerned about how the newly announced Trump tariffs will impact your investments, stay tuned. This topic is for you. We're going to address the three questions cross-border investors should ask about tariffs and market volatility. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Well, joining me once again on the Three Questions Podcast is Steve Calley, Chief Investment Officer here at One Capital Management. Steve has an important role. He is the chairman of One Capital Management Investment Committee. He is a chartered financial analyst. He's a member of the Los Angeles Society of Financial Analysts, experienced portfolio manager, very long-term track record as a portfolio manager. We're very lucky to have, needless to say, not even beyond the fact that he's one of the four founding members of One Capital. Steve, great to see you. We're going to be addressing the three questions cross-border investors should ask about tariffs and market volatility. We were just talking before we started recording. It was only 3 months ago that we had you on. And given all the excitement we've had since the last time, I thought, there's no reason to wait. We should have you back on again. So thank you for taking a break from your regular schedule to join us. Appreciate it very much.
You're welcome. It's and as I said 3 months ago, it's always fun to have a conversation with you, Wayne, because last time we talked about three questions becoming 33, and I think we got 32 of those 33 in the last time. So.
I was just looking at my friend across the way here, Jared Cook, who does a great job of helping produce these episodes. And I think the thought of us going through 33 questions is enough to make him want to just shut everything down. So that's it. I'm out of here. So, Jared, we'll keep it below 33. Okay. Thanks. Barely, maybe. Okay. So before we get to our three questions, I really want to share. We talked about. I want to share something that I hope will give our listeners who are probably wondering right now, what in the heck is going on? I want to just share something to give some perspective here. So I know you remember it, but remember where you were back on September 11th, 2001, because I know I do. I think about it more than I probably should, but I was at a conference with 500 financial advisors. This is my previous life at IPC in Canada. And we were at Deerhurst, which is a resort just north of Toronto, beautiful place. And we were together in a conference room. There were 500 of us. And I want you to imagine this. Harry Dent, who was a very famous money manager, he was promoting a book called The Roaring 2000 Investor. Now, his talk went from 9 a.m. Eastern to 10:30. Well, actually 10:25 a.m. Eastern. And just as he ends his speech, the organizer took it upon themselves to go from Harry's sort of presentation on the screen, and he basically transitioned over to CNN's live broadcast. If you can imagine this in a room of 500 people, big, massive screens, just as the second tower collapsed. I'm telling you something. It's a moment I'll never forget. I don't need to rehash the whole event. It was terrible, beyond terrible. Everybody was frightened. I mean, I saw grown men crying. It was unbelievable. People knew they lost their friends that were working in the towers. I know some of the quotes I'll remember and never forget actually were, I remember a wife of a financial advisor I knew walking down a hallway going, we're ruined. The market, then we heard the market's never going to recover. This time is different. That one came up quite a few times. And so here we are now, Steve, believe it or not, that was 24 years ago. That's unbelievable just to think about. So I want to give you some perspective here. If someone had taken and invested on, say, January 1, the beginning of 2001, $100,000 into like an S&P 500 index at the beginning of 2001, that $100,000 today would be worth approximately $690,000. That will be at the end of 2024. So from 2001 to 2024, assuming you reinvested all the dividends, that money would be worth from 100,000 to 690,000. And think about this. That includes we went through after that, because remember then we had the Great Recession, which again was supposed to be the end, and then we had COVID. So just some food for thoughts.
Well, and even in between there were others. There was the first Gulf War, the second Gulf War.
Yeah. So just to give folks perspective that, this time it is different, and, there's no future. I think, I know you've talked about it before, about the fact that, the term I like to use is reversion to the mean. And I think, I believe you're an advocate of that perspective as well, no matter
Absolutely.
how tumultuous things are. So, like I mentioned, you wasn't, just a little while back, at the beginning of the year, we had you on the podcast, and, our topic, and I would encourage people to go back and listen to it. The 3 questions cross-border should ask about investing in 2025. That came out at the end of January. And we cover quite a few topics, and we're going to rehash some of them a bit here today. We asked the question, are U.S. large cap stocks overvalued, right? If so, is it time to take profits? Should Canadian-based investors who hold U.S.-based investments consider converting to CAD? We had a long conversation about that not too long ago. And we also discussed the probability of tariffs on Canadian exports. We covered all of those in the previous podcast, and I want to give you a chance for a rebuttal now. So if you want to rehash any of that before we get into this is now your chance to sort of to true up the conversation, if you will.
That's a great thing, and you had mentioned at the end of it, we'll have him back on sometime, later towards the end of the year. Well, we're doing this a little sooner than we had thought. But I went back and I re-listened to it as well, thinking about, what did I say? How did I say it? And I have to say, I stand by all of the comments I made, with one possible exception. We talked about tariffs. And again, it was early in the administration. The executive orders were being signed, and tariffs weren't there. And I said, that's a good sign. He's pushing it off. And I said, it's coming. But I think the magnitude of his tariffs, and I think the ferocity of those tariffs were much more than I had expected. So if I had to redo anything, I would probably talk about the tariffs, and we're going to end up talking about tariffs in this conversation.
That's coming up here really shortly.
Exactly. So that's the only thing I would take back. But everything else that I said, including valuations of stocks, and we'll rehash that a little bit. I stand by that. And one of the things that I said right at the end, because the last comment you said, "Hey, Steve, I'm going to give the last word. There's something that we didn't talk about." And I'm going to say we nailed that one perfectly. And that is, I said patience. I said it's early. Things are going to happen. It takes a while. I wasn't talking specifically about the tariffs, but I was talking broad picture of everything, because we talked a lot about the Trump administration, the change, and the market exuberance, which is kind of what led us to the thinking of, are the markets overvalued? Should we take some money off the table? And like I say, I stand by all of that. But what I said at the end, and it holds just as true today as it did 3 months ago. And that was that we needed to have patience, because it doesn't happen overnight. It takes time. Regulatory reform takes time. Now the kind of the tumult that's caused, that the tariffs have caused, that takes time. We've got to get through it. We'll talk a lot more about that as we go on. But I'm going to say the same thing. I'm going to say it at the beginning this time. I'll probably say it at the end this time. And that is that we need to be patient. And your intro and your lead in, and you're reflecting back on a really horrible time, 9/11 and all that came after that. And this time it's different, and it was really difficult time. But patience and time heals. It heals all wounds, as they say. We get back to normal. We make adjustments. I'll just I use this quite a bit, but I'm going to reflect back to a conversation I had with a friend of mine in Salt Lake City. It's 1986. Tax laws had changed in the United States. My friend was running a startup company. They were doing great things, and the corporate tax laws changed. And I said, Dave, what are you going to do? This is going to be devastating to your company. It's going to change things. And I'll bring this back later when we talk about tariffs. But I said, it's going to change everything. What are you going to do? It's going to really hurt your company. And what he said to me, I've never forgot, and I keep it at the forefront of my mind because it is so important. He said, Steve, we'll figure it out and we'll move forward. And that's exactly what we do with all of these things that change, with all of the, I mean, we get really worked up because we're very short-sighted as people and as humans. And we get anxious because we have recency bias. We look at what's happening right in front of us and we think that that's going to continue forever. But that statement that he made to me as a business owner, it was really early in my career. And he said, we'll figure it out and we'll move forward. And so I go back to my word patience. We'll figure it out. We'll move forward. And your reference to the S&P 500, they figured it out. They moved forward. And we moved forward through lots of tumultuous times. And the market's done just fine. Not on a day-to-day basis, but it's done just fine.
Yeah, because, we're not measuring, results in days, really, to be clear.
Right.
Thankfully, most people don't measure the value of their house every day. That's an example. I'm just sort of as an analogy. So,
yeah.
Okay. So Steve, it's time for a bit of a rebuttal here. So, we repackaged maybe some of our content today, but, we're going to be discussing the 3 questions cross-border investors should be asking about investing. That was what we talked about, investing in 2025, but we're going to be talking about tariffs and just all the market tumult. So let's just lead right into it. So question number 1, and I'm going to credit this to a longtime client of mine. As a long-term investor, I am concerned about the impact that tariffs will have on my portfolio. Should I increase my exposure to cash, inflation-protected bonds, or gold? Mr. Callie, over to you, sir.
All right, and I'm going to tell your listeners that if you have those questions, talk to Wayne. Speak to Wayne, because that's exactly what you're supposed to do in times like this. You're supposed to ask questions, and then Wayne is going to come back to you, which is exactly what I would do and what I'm going to tell you right now. And it's going to be, what is the investment for? What is your time horizon? When will you be drawing money? All of those things, because when we look at investments, and especially the different sleeves and asset classes with the investment theme, if you're buying equities, you're buying the profitability of a company that's goal is to grow into perpetuity. Like, change, adapt. I mean, if you look at, some of the long-time companies, you go back and you look at General Electric, been around for, years and years and years. If you looked at what General Electric looked like in 1900, and you look at what General Electric looks like today, they're very, very different companies. But you're investing in that company, you're investing in innovation, you're investing in the long-term growth of that company and the vision that they have for the products and services that they want to provide to their customers. And as an investor, you want to be along for that ride, that long ride. So investing is a long-term, especially when you're talking about equities. Now, fixed income is going to be a little bit different. You're investing for, usually you're investing for current income, meaning you're getting interest off of those dividend payings. But, as we talked about last time, and we've talked about in previous conversations, you're also using that as a diversifier. And we talked about low correlated assets that don't move in the same direction at the same time. Well, fixed income is a great diversifier. So when you have tumultuous times and when you have the market volatility that we've had, usually fixed income is your stable piece of the investment, and it gives you flexibility to do things. So, I don't have to sell my stocks today. I can use fixed income, my bonds, as my store of value for any interest payment or for any payments I have to take, any cash flows that I need. And it gives me time for those equities to recoup, recover, make that adjustment. Steve, we'll figure it out and move forward. That's what companies are going to do. Wayne, we'll figure it out, we'll move forward. And it gives you time to do that. And then, of course, you have, different asset classes. And then we talked a little bit about private equity and things like that, which is all diversification. So the question is a really good one, but it's usually, I'm going to speak broad term. The answer is, if you're invested for the long run and you're invested for the growth of your portfolio over the longer period, then owning equities and staying in equities and not making big changes is the best course of action. Now, I'm going to say, though, for an individual situation, that's when it comes to, you go to trusted professionals like Wayne, and you discuss that. You discuss your individual situation. You discuss your cash flow needs. You discuss things that are coming up that may change your investment. If it's not going to change your investment long term, I think you're adding activity, but not efficient activity.
You're,
by doing some of
the
those
term
things.
I think I would use is you're adding complexity, but not value. Maybe is the right way to put it.
That's a great way to put it. Absolutely.
Okay, you mentioned fixed income. I actually wanted to bring that up. So nice segue there, Mr. Cowley. You just said it yourself. The fixed income part of most of our clients' portfolios plays a significant role, and you nicely outlined it. So one of the questions I tend to get from time to time, not just now, but as a general rule, and it's a good time maybe to update, is currently right now. So for our average, we'll say US based client, with a combination of stocks and bonds, for the fixed income part, what is the average duration to maturity and the yield? And again, this, I realize you can't do it on a client by client basis, but just across the board.
Right.
What are we seeing now in terms of duration? Because we know, historically speaking, we remember back 2001, 2002, we had very short duration because interest rates were so low that there was only one way for them to go up.
Yeah.
And that was up. And as we know with bonds, when interest rates go up, the price of the bonds go down, and how much they go down is directly correlated to how much, how long is it until they mature. So now we're in an environment where interest rates are like, 5.5%, somewhere in that range. Where are we in terms of duration, and what a client should expect that fixed income portfolio over a course of a year is going to yield in terms of a percentage?
Right. So I'm gonna step back and do a little bit of definitional work on duration versus maturity and things like that. And again, it's a very complex mathematical formulation, but the definition of duration, and this is where I'm going to lose everybody, is the weighted average time to cash flow.
Right.
And like I said, I'm going to lose everybody on that one. But basically what that means is it says that how long does it take for me to, if I give you $1,000, how long before $1,000 worth of cash comes back to me? So it's not necessarily maturity in the sense that if I have an interest paying bond, I'm getting cash all along the way. So a 20-year bond doesn't have a duration of 20. It has a duration of around 13 and a half in a normal environment type period. So that's because you're getting cash all along the way. You discount back to, like I said, it's complex. I've kind of lost everybody, but the only reason I bring that up is because it's a really important number, and we talk a lot about duration and maturity because they're synonymous, but they're not. Well, I should say they're similar, but they're not the same. So, maturity is actually, if I give you a bond and it has a 20-year life, at the end of 20 years, I get my money back. If we're talking about duration, we're talking about a little bit different because, again, the complexity of it is there's cash that's coming in, there's all kinds of things. But the reason that we use duration as the number is because it also serves as a useful guide to the volatility that will occur within your bond portfolio. And so, so to describe that is if interest rates move 1%. So if interest rates go up 1% and you have a duration of 13, you have a 13% drop in value. So we use duration, and the reason we use it so much is because it gives us a pretty good gauge of how volatile your bond portfolio is. So when we talk about, so the reason I give you a little bit of that background is because it's important to understand, and I'm going to go back to what we did in, pre 2021 and what we were doing. And, we had a lot of investors for 10 years when interest rates were, next to zero. And we had, long-term bonds at 2% and short-term bonds at, 1 to 1.5%. And people would say, what in the world do you own a bond for? And it was, again, it's the diversifier, it's the stability when you have volatile markets, because we had some volatility in those years. And it gives you a chance to then, again, as we talked about rebalancing, buy low, sell high. Well, when the market gets volatile, you've got a rich asset in your bonds and you sell those high and you buy equities to lower and you can rebalance. So fixed income has a place in the portfolio, even when there's very little interest being generated. And we talked about it last time. What I love about now is we're now getting paid to own bonds as well. So we're actually getting what bonds are supposed to do, and that's pay us a cash flow.
And then we use that money to rebalance throughout the portfolio.
Exactly. So the reason I went into the definition of duration is because back, pre-21, and we talked about it last time, the risk-reward ratio wasn't there. Why buy a 30-year bond with a 2.1% interest and a duration of 16 when rates are going to just go up? So I know I just put a 16% standard deviation volatility into my bond portfolio. No thanks. That's why we were short, is I wanted to keep volatility low. We had high quality, we had low variability. So if interest rates moved, we weren't going to be hurt that much. And the typical bond investor in 2021 was down about 13.5%.
That's right.
That duration.
Well.
That's
Thank God we weren't,
duration.
But yeah.
Exactly. And we were down about 3, maybe 3.5. So we did a really good job of protecting on that upside. So, and part of the reason now why I went back and I definitionally said that is because we've increased our duration. We've increased the volatility in our portfolios. We're up to about 5.5, meaning that there's more volatility when interest rates move in our portfolios. But we did that because the risk-reward ratio has totally flipped. Now you're getting paid to hold that for a little bit longer. Before I was getting a 2%, I'm getting a 1.5% coupon, and I had a 10 volatility. Like, that's a bad risk reward ratio. If the rates move a little bit, I'm south. It's really hard for me. Now that I've got a 4.5%, I'm using the treasury right now. I've got a 4.5% treasury or 4.2% treasury, and I've got a duration of 5. Well, if rates move 1%, I'm only going to be down 1%. I mean, if they were
in terms of the market value of
exactly, if the market went south on us and rates jumped by 1% instantly, my portfolios are going to have, because I'm going to get 4% interest to offset the 5% drop, I'm only going to be down 1. So you can see how that risk reward ratio all of a sudden flipped back in my favor to go longer duration. And so that's one of the things we do. Now, the other thing that we've done, and we've talked about this, Wayne, privately, is we've added, private equity or private credit to that mix. We've added, high yield securities to that. We've added some floating rate first trust notes to that in our fixed income. So the yield that we're getting is around 6.5%. So again, we've got a 5.5 duration and a 6.5% coupon, yield.
On the overall US.
On the overall portfolio with everything. So we've flipped the risk reward ratio because interest rates are where they are. So it pays to be longer because the risk has been minimized. It's still there. There's always risk in your short-term movement, but the risk reward ratio has flipped in our favor. So it pays us to push out and pick up those higher yields and invest longer term, because what you're trying to do is you're trying to lock in those rates as long as you can. What if rates go down? We want them locked in as long as we can. We don't want to lose them because we had a short duration portfolio, because all of a sudden all my bonds are maturing in 1 year, and instead of getting 4, I'm getting 2. That's not what I want to do. I want to keep that 4 for as long as I possibly can. And so again, the risk reward ratio flipped for us. It makes sense to extend our durations. Could we go a
Because
little
we
bit
can
higher?
lock in those yields for a longer period of time.
Exactly. We're trying to lock them in for, on average, around 5.5, 6 years. And that's what we've done with our portfolios.
All right. So that's on the US side. I know we're going to talk about Canada down here in a
Yeah,
minute, but just
and on the Canadian side, rates are just a little bit lower because, the Fed funds rate in the US is 4.25 and Canada's
Canada is about
2.75.
2.75.
Exactly. So
Bank
the
of
rates are
Canada
just
decided today they weren't going to raise rates. So, um, or lower rates, pardon me.
yeah.
No,
And so what happens is we've got about the same duration in Canada. We've got, that same 5.5 to 6 duration in Canada, but our yield's a little bit lower. Now we've added some of these other pieces, but just interest rates are a little bit lower north of the border. And so our yield there, it's probably running around 5.25-ish. So you can see it's a little bit lower in Canada than it is in the US. And
all
I'd
right.
have to get the exact numbers. I don't have those right here.
Yeah, that's okay. I'll give you a hall pass here, Steve. Okay, so thanks again, Steve. And Steve Callaghan is the Chief Investment Officer at One Capital Management. Kindly took some time out of his day to join us here on the podcast. So let's get to question number 2, Steve. Again, what's the word that we've been hearing so much? The word turmoil. So with all the market turmoil, are small and mid-sized companies, we'll call them mid caps, are they still, I know at the beginning of the year, it was kind of like, there's a lot of expectations that, small caps are going to return back to their typical higher return results. Even with what we've been going through now, do you see them still as attractive as they were at the beginning of the year?
As we talked about at the beginning of the year, the answer generally is that small companies tend to do better than large companies because they're smaller, they're more nimble, they've got they're on a faster growth trajectory, all of those things. So historically, part of the reason why the assumption is that small cap grows faster than large cap is because
Right.
they're smaller, they're more nimble. Again, I mean, it's just pure math. If I've got a company and I'm making $1 million a year in profits, to double that to $2 million is fairly easy. Again, no, it still works. But if I've got a company, exactly. But if I've got a company that's making $10 billion in profit, and now I've got to try and double that to $20 billion in profit, it's a lot more work. The math is just the number, large numbers. It's just hard to do. So historically, small cap grows faster than that's the expectation. They have a little bit more volatility because they're a little bit more sensitive to market disruptions. They're a little bit more sensitive to interest rates. They're a little bit more sensitive to market conditions, slowdowns, accelerations. And so the answer to that question is, in the short run, over the next 6 or 7 months, as we're dealing with tariffs and Trump decisions, flipping coins. I don't know how he makes his decision. He wakes up in the morning and decides something different, and then by noon he's had something for lunch and he changed his mind again. And
I'm going to edit this part out, Steve.
But because there's that volatility, because there's a lot of uncertainty in the markets over the short run, the next 3, 6, 9 months, it's going to be a little harder for small caps to deal with that because they're more sensitive to, we're seeing it. We're seeing that with our clients. We're seeing that across the globe. I don't know what's going to happen. I don't know what's going to happen with the tariffs. I don't know if my construction cost is going to go up because of tariffs. I don't know if my factory work's going to be. So a lot of people have sat back. They're sitting on their hands. They're not spending money. They're not, these are consumers, especially we consumers of everyday goods, we're going to put gas in our car to drive back and forth to work. We're going to buy groceries. We're going to do all that stuff. But if I'm buying luxury goods, and again, we saw that with, LVMH, which is the French company that owns Christian Dior and Gucci and all that stuff. They had 3% less sales in the first quarter than they did a year ago. Those luxury items, people are saying, I'm not sure. I've got the money. I'm going to be okay, but let's see how it plays out. And that happens with small and mid-sized companies and their profitability. So they're more subject to people saying, I'm going to wait on my purchase. I'm going to wait on the services that you give me. So I would say that small mid are going to probably struggle a little bit in the next 3 to 6 months. But if the economy does what I think it's going to do, we figure this out, Steve will figure it out and move forward. If we do that, then small cap's going to be fine. It's just been pushed out about a year or so. Then the other side of it is, one of the things we talked about is in the public markets. I think you're going to get a little better growth in the private side of things, in the private equity side of things, because those companies are they've got a little bit more flexibility. Because they're not priced every day in the marketplace. They're marked to market as they look at their books every year. There's going to be more stability. There's a little bit more financial backing to those companies, and they're the growers because they decided to stay private longer, because why not stay private and put the money in my pocket instead of giving it to shareholders on the outside of things? So they're going to be fine.
I want to talk a little bit more about that in a second.
Yeah.
I want to go back to the small cap for a question. So, traditionally, again, I've been with One Capital now, depending on whose metrics we're going to use here, but 12 and 13 years now.
Yeah.
We have utilized in our clients' portfolios small cap exchange traded funds, or ETFs.
Right.
That's what, since the term we used was portfolio completion, to give ourselves some diversification beyond owning individual names and so on. What are you seeing? What are you looking at as a strategy going forward? Is it to remain in those same ETFs, or do you have something different planned?
And we talked about this last time, pretty extensively in our January 27th discussion. We are moving. We're making changes. We talked about an active small to mid cap portfolio. That one where we talked about it in the near term, it was coming. Like, it's imminent. It's in the next 2 to 3 weeks. That fund is going to be rolling out. Well, I'll give it a month, but that fund's going to be rolling out, and it's going to be a more active strategy, so that we're being a little bit more proactive at the companies that we pick. Because we talked about it last time that about 30 to 40% of those small cap companies in the public market that are in those baskets that we've used in the past are not profitable companies. And so we're switching to a more active strategy, trying to weed out the companies that we don't want, be more active at the companies that we do want. And so that's rolling out. That's the small mid cap growth that we've got. We're looking at all of the ETFs that we have there. And then we added the private equity side of things, which really focuses on the small and mid-sized companies as well that are private, which, as we talked about last time, that makes up about, I think it's 89% of the companies in the US that are $100 million or more in profitability are private.
Mm-hmm.
So there's a whole section of the market.
We're not getting any access to.
Exactly. So we've added that with our private equity fund that we've added into the portfolio for qualified investors.
Okay. So I know I'm going to go back to this. I'm going to circle back here. So I know with the private assets, we hired Wilshire, or One Capital hired Wilshire to kind of oversee the choices of what positions we own within that private alternative investment portfolio. For the mid and small cap, will you be directly yourself involved in the selection of those companies, or are you delegating that as well?
So it'll be a fund that is part of the One Capital family of businesses. We have a company up in San Francisco called FundX that is a division of One Capital Management. They have ETFs currently. We're adding this ETF to that stable of products that we have there. But we are sub-advising out the management of that fee. We've found some managers that have been very, very successful. They've got 20, 30-year track records of running small, mid-sized companies. They've been very successful with that. So it's our fund, but we're subcontracting to some experts in that field of small to mid cap side of things.
Okay, now I want to go back and talk about alternative investments for a second. So a year ago, I believe it's almost like we're almost on the anniversary right now, almost, of adding an alternative investment strategy into our clients' portfolios. And on average, I think, typical client will have somewhere around 5% of their exposure in alternatives investments. And so just to go behind the curtains with everybody, you and I have talked over the last week or so about, going forward, the vision going forward in terms of, realistically speaking, and I just put it to you right this way, do you foresee a larger portion or a larger exposure for alternatives, over the next, I don't know, I don't want to pin you down to anything, but say over the next year, can you see maybe that exposure going up maybe from 5% to 10% or even larger? But what's your thoughts on that? All things being as you see things today.
Right. And I'm going to, put the disclosure in, like you said, we don't have a deadline. I'm not, we're not setting
No. Just overall.
But the answer is that I do think that the alternative, and I'm going to call it private investments, they should have a bigger and bigger role in our portfolios. There's a lot of opportunity. Again, 89% of the companies out there that are making a lot of money are private.
They're privately held.
They're privately held. So we want to be part of that. And so the answer is, and now the other thing that we have within our portfolios is we're using a Cliffwater private credit fund. And that is also a private and as an alternative investment. We've kind of just rolled it into our fixed income. It's a percentage of our fixed income. So we have a little bit more than that 5%. We probably are running somewhere, 6.5% with the Cliffwater in our portfolios. But the answer is yes. I think that we'll be taking that number to 10%. There's, with the possibility of going as high as 20%. Again, this is going to be client specific. It's going to be very, it's not going to be everybody, but people with long-term investment time horizons that have the capital to invest and are, accredited investors, it makes a ton of sense to have some private investments in their portfolio. They should have private equity. They should have private credit. They probably should have some private infrastructure or REITs, and we'll be adding those to the portfolios as time goes on. This was a new investment sleeve for a lot of our clients, and we've talked a lot about liquidity, because one of the things that we like is we want to be able to get our money out if you need to. In the private investment space, there are different vehicles and there are different ways to do it. Part of the reason why we were a little bit slow at doing this, we had to find the right vehicles that make sense. So the Wilshire that we added, which is the private equity they added to the portfolios, we were able to take this over. We're able to change the structure of it, and it's a fund that we can invest in it on a daily basis. We can redeem on a quarterly basis. So we have liquidity in a fund that you typically, if you invest in private equity,
you have a long time before you can get
it's a 5 to 20 year tail, depending on what they're trying to do. And there's no given date, because they might say we're investing for a 5-year return, but things happen. And that 5 years becomes 7 years, becomes 9 years, becomes 13 years before you actually get your money back, depending on what happens in the marketplace, depending on what happens at that company. So we wanted to be sure that we had the ability to have liquidity for our clients, because things happen. And so we want to make sure that we have the same thing with that Cliffwater fund. We can buy it on a daily basis. We can sell it on a quarterly basis. Now, there are some restrictions to it, and Wayne can talk to you about some of those, but the quarterly redemption is subject to a 5% maximum, because these companies have to know that they've got money and that it's long term. And so if everybody tried to get out, you don't get your money back. It'll be subject to, right away. You'll get it, but it's going to take a little bit of time. And again, that's not why we invest them. We invest them for the long term. We invest because we really think that there's a lot of great opportunities there, and we want to own those over long term. I mean, my own portfolio, which I own some of that as well. I don't plan on
here.
I don't plan on touching that, because it's part of my long term strategy. With part of my money that's being put to work. I want to have a percentage of it in the private markets, because there's a great opportunity there. And I don't need the liquidity today. if I do, I'll have other investments that I can do it. So the answer is it's going to become a bigger and bigger part of the portfolios. I don't know where it's going to land, but I do think that we'll be
We're
10%
sitting
ish
here,
or
we're
north of
sitting here
10%.
probably April 2026. Odds are we may be able to have a bit more exposure than
Yeah,
we.
and we'll have a little bit different conversation.
Yeah. Okay.
But it's the opportunity is so big and there's so much opportunity there that we need to take advantage of it. And it fits in a long-term portfolio.
Okay. Steve, thanks a lot for filling us in on that. And I do want to talk, question number 3 here. We got to get going here. And you and I have chronically long conversations or unusual, that's for sure. So I want to get to question number 3 here on the 3 Questions podcast. And that is, what is One Capital's strategy when it comes to allocating equities in our clients' Canadian dollar denominated portfolios? So these are, the client could be living in the United States. As you know, we have plenty of clients here in US that are expats from Canada that have relocated here, we're dealing with dollar in the low 70-cent range here now, who are either bringing money with us. I'm having conversations almost every day now with folks who have inherited money. They live here in the US and they've inherited money. It could be anywhere from hundreds to millions of dollars. And they're looking at the currency exchange and going, I'm going to get killed. Right. And so the benefit that we can provide is that we can bring those dollars across the border without having to convert to USD. We can put the money to work in anything from literally a cash holding to a fully invested stock and bond portfolio denominated in Canadian dollars. Right. So the question is, now that I've kind of given some clarity on that, is how are we allocating money? And I guess the best way to do it is to focus on the equity or stock portion. Now, it could be a client may invest 60% in stocks, maybe 80, maybe 40, who knows? But if we look at the equity portion alone, how are we actually, like, I know you've made some decisions here recently about how you're allocating money in those portfolios. So maybe you could just bring everybody up to speed.
So what we would, again, there's actually 2 parts to that question, because there's people taking money back to Canada and there's people bringing money from Canada to the US. So it gets really complex. And you and I had a long conversation the other day about it, and we brainstormed over a number of
90 minutes.
And we ended, again, brainstormed over individual clients and their situations and what was best for them. I'm going to, general big picture rule. It's a lot what we talked about January 27th. With the Canadian dollar as weak as it is, if you're taking dollars back to Canada to convert them up to Canadian dollar, it's not a bad time to do that. We talked about it in January. We talked about, hey, start that. It's not, it's probably not the perfect time, but start that. And it's actually moved a little bit in our favor that way. But coming the other way, because the Canadian dollar is weak relative to where it should be as that's a wrong term to use, but relative to purchasing power parity, which is one of the things that you like to talk about.
Mid to low 80s right now.
Yeah, exactly. So because it is cheap relative to the US dollar on a normalized basis, it's probably better to keep it in Canadian dollar and then convert back as the Canadian dollar strengthens. As it gets to 75, as it gets to 78, as it gets to 80, as it gets to 82, you start taking it the other way, where you start bringing the Canadian dollars to US dollars. Now that said, so that's the currency side of things. It's the Canadian dollar is cheap. Like, you don't have to convert it all to US dollars and get
how do you put that money to work now is the question.
Exactly. So now how we put that money to work is, because again, when we invest, what we really care about, and I'm gonna one of the things you said, because I said we want to buy the best companies. And I said, buy Toyota, the best auto company, and we laughed about that because it's not a U.S. company, it's not a Canadian company, but we want to own the best company. So what we do in that case, and we're doing a Canadian dollar, is we're going to invest in Canadian securities. We can bring down securities in kind. We can buy Canadian dollar securities in Canadian dollars with a couple of the custodians that we work with. So if we like And I'm just going to throw out some names that people know, and we some of them we own, some of them we don't. If you own, if we want to own Canadian Tire, then we're going to own it in Canadian dollars. If we want to own Bank of Montreal, we're going to own it in Canadian dollars. We're going to have that. But in Canada, you have basically three main industries. You've got finance. So if you're owning banks, you're owning insurance companies, you're owning finance companies, you can buy Canadian companies. And is, Bank of Montreal, Bank of Royal Bank, is it, do we own JP Morgan or do we own one of those? They're going to be similar. They're financial services companies. They trade very similar. So own a Canadian, don't own a US in that particular case. But there are industries, and so you've got energy, you've got finance, and you've got minerals and mining and stuff like that. So if you're going to own those, we can buy Canadians real easy. But if you're going to buy a technology company, if you're going to buy a healthcare company, which we own, if you're going to buy some of the consumer durable and consumer staple companies, we want to own Amazon. We want to own, we want to own NVIDIA. We want to own, different tech companies. Then what you've got to do is you've got to buy that in a usually in an ETF structure that has a Canadian hedge to it.
Mhm.
So we'll buy a US large cap ETF that has all of those in it, but it has a Canadian hedge to it, so that the Canadian dollar, we're bringing it over and we're keeping that, that Canadian dollar, and we're buying it I hate to say we can't time the markets, because the reality is currencies over time, they work out. And again, long term, even if you get, quote, killed because you bought US dollars at the wrong time and the Canadian dollar is weak, the reality is, and we talked about this, like the growth rates and the growth prospects in the US are just a little bit better. So even if you did that currency conversion and it wasn't as favorable as you liked, and you put that money into US dollars, in the long run, you're going to be okay. In the short run, it's kind of painful to say, oh, I should have waited a little bit and I would have got a little bit more money out of mine. So we're going to invest where the investments make sense. And then we'll use a currency hedge as needed, where we need it, how we need it, with the individual investor. So we can do that. There's lots of means to do that. If they're really concerned about the Canadian dollar, again, I'm going to say, if I'm a young person and I inherited it and I'm, in my 30s, and I'm going to invest this for the next 25, 30 years, and I'm living in the US, and I'm probably not going back to Canada, I'm not going to be spending money in Canada, then we're adding complexity without adding necessarily value by waiting to do that. You can convert pretty much anytime, because you're going to be putting the money to work. It's going to be growing. And your example on 9/11, that same thing's going to happen. Your time is going to grow your portfolio, and you're going to be just fine. Shorter term, you've got maybe you're going to buy a cottage up in Canada. Maybe there's some other things. Then those currency discussions become more important about how you do that. So again, I'm going to defer back to you, to your clients and their individual needs. But on a broad basis, we can invest, hedge back to Canadian. We can do that through some ETF vehicles. We can do it through different methods. But in the long run, what we want to do is we want to own the right companies. We want to own the best companies. We want to own the companies that have the better prospects. And we don't really care where they're domiciled. We don't really care if they're, we do care their currency, because you've got a little currency conversion, but you can do that in a variety of different ways. So it's not it shouldn't be a concern for Canadians as they bring it down, because we can work with currency. Or, like I said, if it doesn't matter because it's a long-term investment, we can make those decisions as time goes. And again, like we talked about last time, you can do that bit by bit, slowly over the next year or two, as the Canadian dollar strengthens up against the US dollar.
So that's an exceptionally broad range, and I really appreciate the context. I would like to just circle back on one thing, and that is, I know philosophically speaking, and the investment committee One Capital had talked about how much exposure we want to give to Canadian companies now versus US versus international. Now, in our discussions, it's pretty clear is that we've increased our international exposure, our US exposure in a Canadian equity portfolio. I think we've increased it from 47 to 61% of the overall equity portion. Is that correct?
Yeah.
And
Yeah,
And on the international side, we've also
We've decreased that down to about 15% total.
so the U.S. port component of the portfolio is now of the equity components almost 60%, even though it's a Canadian dollar denominated strategy. This U.S. component makes
Yeah.
up 60% of the entire portfolio.
Yeah.
Interesting.
Yeah. And again, how that portfolio, because we're talking to cross-border people, how that portfolio is, whether, how much is Canadian dollar, hedged or denominated, how much is US dollar, depends on where they live, what their prospects are, where they're going. If they're not moving back to Canada, you don't really have to have that, that much exposure to Canadian dollar. If there are some other issues, so if, like I said, I answered that really broad, but how you execute it, getting down into the weeds really becomes individualized person by
100%.
person in their situation.
So just before we wrap up, there is one additional question I want to ask before we wrap up the podcast. And I want to focus specifically on, again, Canadian dollar investors, whether they're in Canada or here in the US holding US portfolios. There is a lot of concern. I've talked to a lot of clients in Canada. Needless to say, none of them are too thrilled with the current environment on many different levels because of these proposed tariffs, and notwithstanding some of the other comments that have been made, which actually get people even more upset.
Yeah.
I guess the question I'm going to ask you with regards to the Canadian economy, Steve, do you see any silver lining or reasons for optimism? You're living in Canada right now. You're listening to the podcast. Your money is invested in your Canadian portfolio, and we have all this sort of unquote unquote uncertainty. Where's the optimism as far as you're concerned?
So I'm gonna take a half a step back, and I'm gonna address a little bit of the tariff issue, because that's a big part of what's causing this. And we talked about it last time, and I said, if the tariffs that hit Canada were 25%, that would push Canada into a recession.
Mm-hmm.
That still holds true. Now, interestingly enough, I'm chuckling because we speak so much about tariffs, and tariff is a tax. And I've been saying this for quite some time. I didn't say it in January, but I've been saying it ever since. Tariff is a tax. That's all it is. But as a tax policy, I think it's a poor tax policy. There's so many unintended consequences with tariffs, which is exactly why we have this question. What's it going to do to the Canadian economy? What's it going to do to small companies? What's it going to do? What about our relationship with Canada? I mean, these are one of our closest, it is our closest border. We have, historically had very, very good relationships with Canada, and we've damaged that. Again, these are the unintended ancillary consequences to doing a tariff. And then it's, again, because Trump's messaging and his he's got three prongs to this, and we talked about it last time. I'm going to kind of flip them up a little bit, but he's trade policy, and is it fair, and should Canadians tariff U.S. goods when we don't tariff Canadian goods? Again, you get into the weeds, and there's tariffs all over the place, and we've talked about that before. We tariff soft lumber coming out of Canada, and Canada tariffs, agricultural products going up into Canada because they're protecting each other. And again, I don't want to get into that part of the weeds, but it's just bad policy. It's just bad trade policy. It's bad tax policy because of the unintended consequences. The other thing is he's not focusing on just tariffs. I mean, if we were talking to Canada and said, hey, Canadians, you're not letting our poultry products, you're not letting our milk products, you're not letting our agricultural products come in, and your soft lumber, and we're not letting yours come in. If that was the discussion, I'm going to say I'm okay with that, because every administration has that. We've seen soft lumber tariffs go up and down, up and down. We've written about it over the years. We've taken advantage of it because of some investments that we've made on that. But that's okay. But he's also saying that it's also a trade deficit. And I looked at the numbers, and Canada runs a trade surplus, if you will, with the U.S., meaning Canadians export more goods to the United States. And this is going to get to one of the silver linings. But he's addressing the tariff by saying, well, you're selling us too much stuff, so you got to buy us more things. That is one of the silliest arguments I've ever made, because I want to buy goods and services, the best goods and services. I don't care where they're made. And I want it to be the best price for me. That's what capitalism does. It allocates capital and resources to where it's most efficiently used. So without tariffs, I don't care if we run a trade deficit. If in China's case, for example, they run a big trade deficit with us. They export to us about $485 billion a year, and the total trade with them is 590 billion. So you can see the difference between, they get about they sell us about 300 billion more than we sell them. Again, who cares if I'm getting good product and I'm getting it at the right price and I'm getting, that's just efficient use of capital. Now, we could get political and we could argue that, labor laws and all that stuff. And we'll defer that to another conversation that we have, because it is maybe worth having. But when you look at Canada, for example, the total trade between Canada and the US is about 762 billion. The Canadians export to the US 413 billion. If you do the math, the gap, the trade surplus that Canada have is pretty small. Now, let's look at populations. The US has 350 million consumers, and Canada has
40 million.
40 million consumers. Do the math. Who's going to buy more stuff? So surpluses don't make a lot of sense to me. So that piece of it just doesn't make any sense. And so that's where, like I said, that's where the relationship and that's where the messaging is bad. Now, to answer the question, I wanted to do that because there's a lot going around, and some of it I'm going to give them a pass on, because there's the tariffs that U.S. companies have to pay into China are astronomical. There are some issues that need to be addressed around the globe, but not trade deficits. Again, it doesn't make sense. I've got 40 million consumers in Canada. I've got 350 million consumers in the U.S. Who's going to buy more? You're going to run a trade deficit. So I'm going to leave that, and then so what are the silver linings to Canada? There's some issues that are being caused. There's some hard feelings being caused. There's the issue of if the tariff is 25%, it could push Canada into a recession. Now the reality is Canada's not going to have a 25% tariff. I mean, if we've noticed, what's happened is I'm going to hit them with the 25% tariff, and then I'm going to, I'm exempting all of the lumber and the building products because we need building products. I mean, okay, now you just defeated the purpose of putting a 25% tariff on it. Now we're gonna exempt the cars and the auto manufacturing that comply with the USMCA, but some isn't. So some will be tariffed, some won't be. So you can see how that 25% tariff goes way down really fast. And then when you look at that, you look at the trade with Canada. I'm just they export $413 billion a year to the U.S. Well, the U.S.'s GDP is 28 trillion.
It's a rounding error, Steve.
It is. It's minuscule. It's not going to be. It's not going to be as devastating as what you're hearing in the media and the politicians and all of that. And I said that back in January. It's a little bit more on us and all of that. So again, step back, be patient, let things play out. It's not nearly going to be as onerous as that 25% sounds. It sounds really bad. It's not going to be that bad. It's not going to be that bad. So now I'm going to get to now I'm going to answer your question, now that I kind of gave a little bit of background and said that. But, the energy sector in Canada, it's a real silver lining. I mean, we've got, it's going to continue to be robust. They can produce oil. Oil's a little up over 60, I think it's $62 today. West Texas Intermediate. And the Canadians can produce a lot of oil and make a lot of money selling it at those prices. The U.S. gets cheap oil. We get cheap oil, we get cheap natural gas, we get cheap electricity from Canada. As you saw when Quebec, I think it was Quebec, was going to shut off the electricity coming into the US. I mean, you saw it was just it's like, oh no. So again, these are types of things that's not going away. That energy sector is a great thing. Now, the mistake that Canada made in that is they should have developed their own resources to,
For refining.
to refine it. They should have, again, and I'm not speaking anything the Canadians don't know, but you can send a gas pipeline west, but you can't send a gas pipeline east because of, I'm gonna leave that to the Canadian politicians, but you can't build a gas pipeline when you got natural gas in Alberta so you should be shipping it because guess where, like all of the natural gas that goes into Eastern Canada, not all, but a big portion of it comes out of the US. And yet Canada has more gas than they know what to do with. Build a pipeline east. Provide, don't rely on the US. And again, maybe this is one of the silver linings that's come out of it. The politicians will say, hey, wait a minute, we can do better than just shipping it all to the US and subsidizing the US. I mean, this, again, the thing where Trump's got it wrong. But send oil down here, we refine it, we send the gasoline out all over the world, we sell it as an export product. It's an import as a raw material, we sell it as an export product around the globe. We get your natural gas and we LNG it out of Houston and we ship it off around the globe. Put an LNG terminal on the East Coast and put an LNG terminal on the West Coast of Canada, and now you've got a diversified market. You don't have to sell to the U.S. So there's actually a lot of good things that can come out of this that I think that can be exploited. And so the energy sector, I think, is, and again, we've talked about. I don't know if we've talked about it, but the energy demand is growing up. And when you talk about, when you talk about AI and you talk about the technology and the tech, like there's a tremendous amount. And then we won't talk about EVs, but the more you convert to EV vehicles, the more you convert, like that's another huge, energy need. Now, what people forget is that, electricity doesn't come magically out of the wall. There's actually a source that produces it. And it's usually, it can be coal, it can be natural gas, it can be a whole bunch of different things. So
we know that the demand for energy, Steve, over the next decade is supposed to like almost go up like threefold. So to your point.
And again, as the world gets wealthier and the developing markets get wealthier, the demand for energy is massive there. I mean, we live in North America, where Canada and the U.S. is. I mean, we've got energy demands that are growing at with demographics, 1.5, 2.5, 3%. Now we've got AI, and so that number is growing to 4, 5, 6%. Again, we got massive energy, so that's not. But if you go to South America, if you go to Africa, if you go to a lot of the Asian countries, the demand for energy is massive. This is again, that's not changing anytime soon. Another silver lining and kind of changing it around is, because of the threat, because of the uncertainty, as you said, Bank of Canada left rates alone today.
I'm just going to bring that up, actually.
But their short-term rates are 2.75. Your long-term rates are lower. You've got Canadians. And again, I'm not telling you anything that you don't know because you lived there for a long time. But you will get a 30-year amortized mortgage, but it has resets at 5 to 7 years.
5 years, usually every 5 years, there's a lot of mortgages that are going to be coming up for renewal.
There's a ton of mortgages that are coming due. And 3 years ago, rates were really low. 2 years ago, rates went really high, and then this is pushing those rates back down. So interest rates in Canada are very doable. They're
for homeowners looking to renew right now.
Homeowners, it's a good time to renew. The consumer who's using their credit cards, those numbers are down. It's not the end of the world. And again, these are some real positives to the economy. You can weather the storm when you have lower interest rates. You can weather the storm when you have that. So is the economy going to slow because of the uncertainty? Yes. Is it going to slow in the U.S.? Yes. Is it going to push us into recession? Probably not. We might have a little bit of an anomaly, especially here in the U.S., because everybody in anticipation of the tariffs, like trade went way up. If you look at the trade deficits, I mean, if I'm an importer, I'm buying as much stuff as I can get through the doors as fast as I possibly can.
Last couple of days show that consumers are front loading their purchases in a big way here over the last.
Consumers, corporations, everybody is front loading that. So we're going to get an anomaly where March looks really good and the March numbers came out. They look great. April numbers and May numbers are going to look pretty bad, but it's only because we front loaded and that'll go away. And so, like I said, patience. Will there be a slowdown? Yeah, we'll figure it out. We'll move forward. And the fundamentals and where we are globally, in spite of the tariffs, things look really good. Inflation is coming down, interest rates are coming down, consumers.
Full employment here in the U.S.
Full employment. You've got full employment, in most places. There's a lot of really good news, and that will reaccelerate once we get through the uncertainty created by this tariffs. And again, I'm going to go back to tariffs are a tax, and we could spend I've got some other numbers. I'm not going to throw them out today, but a tax is a percentage of GDP. The other thing I will say this: if Trump got all of the tariffs through, it's a tax, and it got passed through to the U.S. consumer, the tax bill for the U.S. consumer would be increased by about $258 billion. Which is a big tax increase. If he got his tax cuts through that he's trying to get through Congress, that's about $222 billion. So it's not the offset's not that much tax. Now,
yeah,
he's probably
the
not gonna
argument I would make on that, though, Steve,
I'm gonna push that one aside and say he doesn't get any of it.
Proportionate number of people would be getting taxed anyway.
Absolutely. Now again, I'm gonna push. I'm gonna say so we don't get that. Let's just focus on the tax increase. $258 billion. If you put that in perspective of tax increases in the US, it is just slightly larger than Bill Clinton's tax increase. And nobody looks at it that way. It's a tax increase. It looks and feels bad, but it's really not that much bigger than what Bill Clinton pushed through when he did it. Again, we're talking minuscule difference between the tax increase. So now it's not going to happen that way. The tax revenue from it is not going to be as big as he thinks it's going to be. It's not going to be $258 billion. It's going to be something. The tax cut's not going to be $221 billion.
That's the part that remains to be seen.
Exactly, and that's why when I started this, when I started this thing with have patience, like we have to have patience. We don't know. I mean, I'm just threw out like best case scenario for tax collection, which is, and that all gets passed through to the U.S. consumer. I'm just trying to put it in perspective. It's a big tax increase, but it's in the middle of tax increases in the history of the United States. It's not as onerous as people think. It's not the granddaddy
of all tax increases.
It's
just
not.
On the other side, if everything goes to plan, there's going to be some tax reductions on certain things like Social Security and tax on tips and so on. Exactly. The ultimate goal, we know that, if they can save $1 trillion on government expenses, increase revenue by $1 trillion, reduce expenses by $1 trillion. Supposedly the idea is that anybody earning less than $150,000 a year won't pay any income tax at all. That's the fantasy, I guess.
Yeah, and I'll put my 2 cents on that. Anybody that lives in a country like the US, Canada, Europe, like we all should have some skin in the game. I use the roads, I use the schools, I don't care who you are, you should pay something because if I'm paying for it, I'm going to hold the politicians accountable for it. If I'm not paying anything, and I think that's one of the problems that we have, and it's going to make me sound a little cold-hearted, but one of the problems we have is if you're at the lower income side of things and you're getting everything for free and you're getting tax credits and everything else, then tax the rich sounds great. But if I have skin in the game, just a little, 5% of my income, I'm going to be thinking about how that money is spent on my behalf, much more so than it wouldn't. And nobody's going to listen to me.
I can't argue with you, so we're on the
nobody's going to listen to me on that, but I think everybody should have some skin in the game. I don't care how, if I make $1,000 and I pay $50 in taxes, I'm thinking about where's my $50 being spent.
Well, Steve, as usual, I'm almost afraid to see how long we've been going for here. Okay, so I'm going to ask you the same question I did at the end of the last podcast. Believe it or not, we are there finally. Okay, so folks, listen to our last episodes, and the message at the end of the last episode was you have to be patient. So here we are, end of episode, at this episode. What would you say to those listening in today, as a wrap up? Is there anything that we didn't talk about or anything that we didn't address that you think that you would like to have a sort of a final remark?
I think we've really talked about everything. I think the final remark would be, again, patience. The final remark would be, we still don't know. There's still a lot of unknowns. We're talking about tariffs. There's a lot of speculation still about what's going on.
Absolutely.
And so just remember that it's mostly speculation. So what we're getting worked up about may or may not happen. So step back, say, wait a second, let's let this play out. Let's actually figure out what's going to happen before we react to it. And then I think that's my final part, is that we're still in the speculation state. We still don't know. We can spin 100 different scenarios off of what we think we know, but we don't know yet. So let's let it happen.
Okay, I may throw in the final comment here.
Okay.
This is a line that I heard in sort of a life context, is that 99% of the things that we worry about never happen. How about we leave it there?
I like it. Thanks.
All right. Steve, thanks again for joining us. Steve Cowley is the Chief Investment Officer here at One Capital Management, and he is the Chairman of One Capital Management's Investment Committee, meaning ultimately Steve decides how our clients' money gets invested. So thanks, Steve, very much for joining us again today. And
always a pleasure.
As the saying goes, more shall be revealed, right, Steve?
That's right. That's right. We'll do this again. All right.
Take care, Steve. Thanks a lot.
Bye-bye.
I look forward to bringing you the 3 Questions podcast, and I hope you do find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Last but not least, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with me. Thank you, and we will see you soon.